So this talk is based on a report that I did for the Canada Centre for Policy Alternatives. It'll be published in May. And basically the analysis that I'm about to talk about is the analysis that's in that report. So when it's published, all of the kind of footnotes and citations to what I'm about to show you will be available. So what I'd like to do is start out giving you some global context on energy. How much energy do Canadians use relative to the rest of the world? Where is the world going in terms of consumption of energy, fossil fuels, renewables, large hydro? I'd like to look at the so-called shale revolution, which really started in the US back in the mid part of the last decade. Started off in East Texas in the Barnett shale field and expanded very rapidly from there. I think that US shale plays are a good analog for what we can expect to happen with shale in Canada. I'd like to look at Canadian gas supply forecast of the future as well as history. Where is gas production and consumption gone in Canada? And then look in detail at BC LNG, some of the proposals, what that would take in terms of drilling, environmental impacts and so forth. And finally, some implications for long-term sustainability. So if you look at the world, this is the last 4 decades of consumption of energy back to 1965. You can see, first of all, consumption of energy in the world has more than tripled. It's up 238% since 1965. If you look at consumption by fuel, you can see fossil fuels are over 90% of total consumption. Nuclear and hydro are the bulk of the rest, and non-hydro renewables, things like wind, solar photovoltaics, biomass and biofuels are only 2.7% of total Canadian or total world consumption. If you look at 2013, this is consumption by fuel in the world. You can see, first of all, oil is the most important fuel source in the world, followed by coal and natural gas. Large hydro is next, and nuclear is next. As I mentioned, non-hydro renewables are 2.7% of the total. If we look at non-hydro renewables by source, we can see that there's been an exponential growth in things like wind, solar, photovoltaics, and biofuels, but from a very small base. So their total contribution to energy consumption is very small at present. A lot of non-hydro renewables are in fact biomass, burning electricity, or burning biomass for electricity. If we look back 160 years to 1850, this is what per capita consumption of energy by fuel looks like in the world. You can see, first of all, that per capita consumption has grown by a factor of 9-fold from 1850. In 1850, consumption was 80% biomass, wood, 20% coal. If we look at 2011 in this case, the average world citizen is consuming the same amount of renewable energy, hydro and biomass, as the average citizen was in 1850. It's just that they're consuming 9 times as much energy. And 88% of that is non-renewable. Coal, oil, gas, and uranium. Another interesting point is people sometimes think that oil replaced coal, but in fact oil didn't replace coal. Oil simply added to the total consumption of the average person. Natural gas added further still, and uranium added further still. So one fuel did not replace another fuel. If you look at cumulative consumption of fossil fuels since 1850, 1950, this is a percentage, we've consumed about 3.2 trillion barrels of oil equivalent in the last 160 odd years. 90% of fossil fuels have been consumed since 1939 and 50% since 1987. So consumption of fossil fuels is going up at an exponential rate. Forecast of the future. This is a recent reference case or new policy scenario forecast out of the International Energy Agency in Paris, suggesting that in 2040, 74% of global consumption will still be fossil fuels. 19% will be renewables, and the balance will be nuclear. So that represents a 35% increase in consumption from 2013 to 2040. If we look at non-hydro renewables, bioenergy, burning biomass for electricity is the biggest component. How much energy in terms of fossil fuels will that forecast take? To 2035, this is a forecast out of the US government. We will need the equivalent of 80% of all of the fossil fuels burned from 1850 to 2012 in order to make it through the next 22 years. So the upward spiral of consumption of fossil energy is not going to stop. If this forecast came to fruition, we'll have consumed 5.8 trillion barrels of oil equivalent by 2035. The obvious problem with that is climate change, global warming. This is a correlation between the cumulative consumption of fossil fuels, basically 90% of them burned since 2040, and global temperature relative to a baseline in 1960 to 1990. So global temperature is up about 0.5 degrees centigrade since the 1960 to 1990 baseline. If we look at where those fuels will come from, oil being the most important fuel source, we can see that really the only growth in global oil production since the beginning of 2012 is North America. North America, thanks to shale oil and tar sands, has grown by about 49% in terms of oil production just since the beginning of 2012. If we look at the rest of the world outside North America, oil production has actually fallen by a little over 1%. If we look at natural gas, we see a different story. Canadian gas production is now down by 15% since the year 2000. US production is up 27% thanks to shale gas. The rest of the world is up 50% over that time period. So the rest of the world is growing much faster than North America in terms of gas production. If we look at the cost of finding and producing oil in the world, the light blue line is the amount of capital invested in upstream oil and gas production. The dark blue line is the actual increase in production. So the CapEx has more than doubled since 2005, and we've increased production by about 3%. So it's costing more and more and more in order to provide the oil that the world consumes. If we look at Canada, this is the growth in consumption of energy in Canada over the last 40 years. Canada is blessed with a lot of large hydro resources. This is very different from many countries in the world. But oil is still the #1 source of energy, followed by natural gas. Large hydro is third, nuclear is fourth, coal is fifth, and non-hydro renewables are only about 1.6% of consumption in Canada. So if you look at 2013, we can see non-hydro renewables, 1.6% of consumption. And we can see that biomass is a huge portion of the non-hydro renewables that we have. We've seen an exponential growth in wind, but again, from a very small base. It's interesting to look at how Canada stacks up in terms of per capita energy consumption compared to the rest of the world. And you can see that Canada in this chart is a very high user of energy on a per capita basis. Number 2 in this case, second only to the United Arab Emirates in the Middle East. Canada consumes 5.3 times as much energy per capita as the average citizen in the world. We consume considerably more energy per capita than the average American. If we look at the industrialized world, 18% of world population, we can see that they consume about 3 times as much energy per capita as the developing world, the non-OECD world, with 82% of the world's population. So the problem being is that countries like India and Bangladesh with very low levels of per capita energy consumption aspire to much higher first world levels of consumption. The trend of per capita consumption in Canada over the last 40 years, per capita consumption has gone up about 61%, and it's essentially stabilized since the mid-90s, so it really hasn't got any worse. Per capita consumption of oil in Canada really peaked in 1979, so we've become more efficient users of oil over that period on a per person basis. Total consumption is the product of population and per capita consumption. And this is the UN's estimate of where population will go in Canada over the next 90 or so years. The blue line is the median. And they're suggesting Canada will top out at about 45 million people sometime in the middle of this century. So even if we reduce per capita consumption, if we increase population, total energy consumption isn't changing. How does Canada stack up in use of non-hydro renewables? Things like solar, wind, geothermal, biomass, and biofuels. We can see that we're substantially below the world average at 1.6%. The world as a whole is 2.7. The US is 3.8. And countries like Denmark is really number 1 in the world. 20% of all energy consumption is non-hydro renewables. And a lot of that is wind. Germany is right up there as well at about 10%. If we add in large hydro though, Canada has such a large proportion of large hydro, it really moves Canada way up in the rankings in terms of use of renewable energy sources. Although there are obvious issues with large hydro in terms of the environmental impact. But if you include large hydro, 28% of Canada's energy comes from renewable energy sources. World as a whole, about 9.4%. Turning to shale, which has really been hailed as a panacea, as a source of oil and gas. Basically over the last 10 years, it's emerged on the horizon. This is a distribution of shale plays in North America. Started out in Texas in the Barnett Shale, and now there's huge production from the Marcellus in Pennsylvania and West Virginia. And in Canada, we have substantial resources, in particular in northeastern British Columbia. The Montney Play, the Horn River Play, and a couple of other smaller plays. Conventional wisdom, particularly in the US, would have us believe that the US is on the verge of shale, or energy independence, rather, thanks to the shale revolution. Tight oil, which is really analogous to shale oil, will allow U.S. production to exceed that of Saudi Arabia, and U.S. imports will shrink to zero. Shale gas production will continue to grow for the foreseeable future, and prices will remain low, below $5 for the next 10 years or so. Gas is just under $3 as we speak. Shale gas can replace substantial amounts of oil for transport and coal for electricity generation. It certainly has been replacing coal for electricity in the U.S. The way is clear for U.S. LNG exports to monetize the shale bounty. Crude oil exports, which have been banned in the U.S. since the 70s, should be allowed to monetize tight oil production. I've looked intensely at all of the shale plays in the U.S. We published a major report on them called Drilling Deeper. It's a free download on the net. I looked at all of the major shale gas and tight oil plays in the U.S. and made projections of what future production would look like. And it became evident that there's a pattern with these plays. A play like the Haynesville in Louisiana was unknown in 2007. It was discovered. The discovery was followed by a leasing boom. The leasing boom was followed by a drilling boom because these leases have to be drilled in order to hold the lease. Shale plays are not uniform. They have sweet spots of high productivity wells where the economics are best. Those are found early on in the drilling boom. They're targeted and drilled off first. Production rises rapidly and is maintained for cash flow, even though you might not have drilled some of those wells if you knew the full cycle economics. Sweet spots become saturated and well quality and field production decline as drilling moves into the lower quality parts of the reservoir. So the industry always drills its best locations first. Plays like the Haynesville become middle-aged after just 5 years. So if you look at the Haynesville as a prototype of the shale play life cycle, this is what it looks like. Discovery in 2007, leasing boom in 2008, drilling boom, which extended right up to peak production in early 2012, was the biggest shale gas play in the U.S. in 2012, followed by production decline. It's now down nearly 50% from where it was at peak. If we look at the forecast for shale in the U.S., this is the U.S. Department of Energy. They're suggesting that traditional sources of gas in the U.S. will be relatively flat going forward, essentially on a plateau. Shale gas will grow by 150% over this period. It will provide 53% of production by 2040, and 15% of that production will be surplus to be exported as LNG. So a very aggressive forecast. This is what actual shale gas production looks like in the U.S. by play. Huge growth in the Marcellus in the Northeast. But if you look at five plays that have cumulatively peaked in 2012, they're now down 21% below peak. So the first plays to be developed in the U.S. are now already past peak. This is where it all got started, the Barnett in Texas. The wells are colored by well quality, so that they're colored by the amount of gas that comes out when they're first drilled. The red wells are the sweet spot, they're the highest. The black wells are low productivity wells, which constitute the bulk of the play. So the red areas surrounding the city of Dallas-Fort Worth are the ones that got drilled first. This is what production in the Barnett looks like. It peaked in 2011. It's now down about 18% below peak. They've drilled 16,000 active wells. There's another 4,000 wells that have been drilled that are no longer producing. The Achilles heel of shale gas is very steep decline rates. This is the average decline rate of the Barnett, and production is down about 75% in the average well over the first 3 years. So the message is you have to keep drilling, maintain a drilling treadmill in order to keep production up in these plays. If you didn't drill a well after the first of the year in 2013, this is what Barnett field decline would look like. So production would decline about 23% in the first year. So that is the amount of production that has to be replaced by more drilling to keep production flat. We can see what's happening in the Barnett with well productivity. You drill the best spots first, and then you move into the lower quality parts of the play. Well productivity peaked in 2011 when the Barnett play peaked in terms of overall production. And it's now down 17% from peak. So even though the drilling companies were selling drillers the best technology that money would buy, it's not making a difference. It can't offset declines in the quality of the rock that's being drilled. It can make it slightly better, but productivity will always fall as you move into lower quality parts of the reservoir. And this is typical with every shale play. If you look at production in the Barnett by county, you can see Tarrant County, the top county, produced 32% of all the production in the Barnett. There's 20 counties involved in the Barnett, but 2 of them produced 56% of the gas. 5 of them produced 92% of the gas. But most of the remaining area to be drilled is in the lower quality parts of the play. This is what Tarrant County looks like right now in terms of well footprint. It's been drilled to over 8 wells per square mile. And in essence, Tarrant County is saturated, so there's no choice but to move into lower quality parts of the play. The plays in Canada are much less mature in terms of the level of drilling they've got to so far. So we've got a ways to go before we get to this level of maturity in Canadian shale plays. I made a projection. What's going to happen with Barnett production going forward? It really depends on how fast you drill. If you increase drilling rate by a factor of 5, you could reverse that decline and push the peak of the play out a few years. But the decline after that peak would be much more rapid than if you drilled at a slower rate. So for each of these plays, I picked what I consider to be a most likely drilling rate going forward. And then I compared that to the US government forecast. And this is my call for the Barnett, the red being my prediction of what future production will look like, the blue being the US government's projection. They're projecting a turnaround in productivity and a rapid rise up to its previous peak by, in essence, 2040 in this case. And I've scratched my head as to how they think that will happen based on the basic geology of these plays. If you add up the top plays in the US, these account for close to 90% of US shale production. I can see a peak coming before 2020. And at that time, the price of gas in North America is going to have to move up in order to justify drilling the wells to stem the decline in gas production after that point in time. So I think the current low prices in North America are likely a temporary phenomenon, and we're looking at higher prices within the next few years. The comparison of the US government forecast to my forecast in red, they're going to have to find several more very large shale plays in order to meet their shale gas forecast through 2040, in my opinion. So the takeaways on shale: very high field decline rates mandate sustained high levels of drilling to maintain production. Production from the top plays in the US will likely peak before 2020. Tight oil production, plays like the Bakken and the Eagle Ford, will likely peak in the same time frame and decline. Increasing drilling rates significantly over current levels will raise the production level at peak, but will make the supply situation worse after peak. High-quality shale plays are not ubiquitous. High-quality plays are relatively rare in terms of the total scheme of North American geology. So if we turn to LNG, this is the 2013 throne speech from Victoria. They made several claims about BC LNG. One of them was we can help protect our planet. We can displace dirty coal in Asia by BC LNG. We can create over 75,000 new jobs. And I see just on the wall outside here that Rich Coleman is now saying 100,000 jobs. We'll create a British Columbia Prosperity Fund from the royalties and the taxes that could exceed $100 billion in the next 30 years. And we could do things like eliminate the provincial sales tax. Well, how realistic is this going forward? If we look at the proposals, there's about 18 proposed LNG facilities. These are the northern facilities. There's 14 of them on this map. If we look at the ones in the Prince Rupert area, there's 8 proposals. If we look at the Kitimat area proposals, there's 4 of them. And if we look at the southern BC proposals, there's another 4. So a total of 18. There's also a lot of other infrastructure that has to be built in order to service those terminals if they are built. And these are pipelines that are being considered at this point in time. There's 5 of them. If there were more than, say, 5 terminals built, this would be insufficient supply. We'd have to probably up the capacity of those pipeline inputs. So I added up the total proposed capacity of all of those 18 terminals, and it comes out to close to 300 million tons per annum of LNG exports. If you compare that to the total LNG trade in 2013, it was about 240 million tons of annual output. So obviously, all of those 18 terminals are not going to get built. The world doesn't need to have double the current LNG trade. For the report that I mentioned that will be coming out in May, we looked at 5 scenarios. So the high scenario is really the high scenario of the BC government, which is 5 terminals. The low scenario was 1 terminal. And then we looked at 3 intermediate cases. The BC government intermediate case is 50 million tons per annum. So that's this one. So those 3 middle proposals would be 2 to 4 terminals in total. If we look at Western Canada, this is the distribution of all wells that had at least some production, 1950 to 2014. There's close to 300,000 wells on this picture. There's been close to 800,000 wells drilled in total in Western Canada. So Western Canada is a fairly mature oil and gas exploration area. If we look at gas production in Canada, this is 2000 to 2014. We can see that Canadian production peaked in 2002. It's now down about 19% from peak. 2/3 of that gas was produced in Alberta. 28% was produced in British Columbia. If we look at the total history of gas production in Canada, 1965 to 2014, and in this case it includes the reference case projection of the National Energy Board, published in 2013. Production peaked in 2002, it's now declining. The NEB is suggesting that it will continue to decline till about 2017 and then undergo a miraculous renaissance in production, climbing to near the 2002 peak by 2035. And if this reference case forecast actually happened, BC would be producing 61% of Canada's gas at that point in time. Alberta will continue to decline, hit a plateau, and perhaps go up a little bit in the next 15 or 20 years. The black line is Canadian demand for gas. So Canadians are consuming more and more gas. There's a crossover between supply and demand toward the end of this decade, and really not a lot of surplus for export right through to the end of this projection period. Some people would say that's a fairly aggressive production growth scenario from the NEB. If you look at that report, which is really a major basis for my analysis, the NEB actually had 3 scenarios. The reference case is in black. So the solid black line is the net available for export. The dotted line is the net available with one LNG terminal. So if we built one terminal, according to the NEB, Canada would have no additional surplus gas for export. And that's assuming a more than tripling in output from BC. The high case, Canada could have more than one terminal. The low case, Canada couldn't have any terminals whatsoever. We're going to plunge into the net import territory almost right away in terms of Canada's gas requirements. So I looked at the reference case. I assumed that was correct. And I looked at things like how much gas would we need to meet various combinations of LNG exports. Where does the gas come from in BC? More and more of the gas is coming from unconventional plays like the Montney and the Horn River. So when this cutoff was in mid-2014, 57% of production came from those 2 plays, the Montney and the Horn River. All of the other production of gas in BC was falling quite steeply. And the projections are that most of the future gas will come from unconventional sources. If we look at the distribution of the Montney and Horn River, the Montney is a huge play. A lot of it is in BC, but a lot of it is in Alberta as well. There's about 2,000 producing wells in the Montney in British Columbia. There's about 250 producing wells in the Horn River. And there's a couple of smaller plays, the Liard play to the west of Horn River, the Cordova and Bayment to the east, which are even less drilled in the Horn River. If we look at how much gas would we have to produce to get 1 million tons of LNG to Asia, well, it turns out at the wellhead, we produce what's called raw gas, which has impurities in it. Horn River gas has about 12% CO2, but all gas has other impurities that have to be stripped in order to make marketable gas. So the average shrinkage is about 13% to get to be marketable. If the LNG terminals are gas derived, so gas is the energy that's used to liquefy the gas, to regasify it, the total process uses about 20% of the gas that's delivered to the LNG terminals. So put these 2 together, To get 1 unit of gas to Asia, you need to produce 1.44 units at the wellhead. So one needs to factor that into the calculation of how much gas is required. This is what it looks like if we built 5 LNG terminals. So the NEB forecast, the tripling of BC gas production, includes 1 terminal. So this is what that forecast looks like. This is what Canadian gas production would have to look like to provide enough gas for the 5 terminal case. So in this case, we need to grow Canadian gas production by 100% from what it currently is. And 48% of all Canadian production would be exports, would be LNG exports out of BC if we built 5 terminals. I looked at a second case. What would the comparison be if we just kept BC production at current levels and then compared, so all growth in BC production would go for exports. In that case, we don't have to grow Canadian production as much, but we still have to grow it by about 75% for the 5 terminal case, in which case 57% of Canadian gas production would be exported. So extremely aggressive growth forecasts are required in order to meet even a 5 terminal case. What does that look like compared to the amount of gas available for export, the solid black line? This assumes the NEB reference case, so we'll have growth in BC production. If we build 1 terminal, we have no gas left for export. If we build 5 terminals, and the NEB is right with its forecast, we're going to need to import 69 trillion cubic feet of gas, probably into Eastern Canada, in order to have enough gas to export out of the 5 terminals in Western Canada. This is the second scenario where we just keep BC gas production flat at current production levels. In that case, Canada becomes a net importer anyway in about 2028 with no terminals. If we build any terminals, Canada becomes a net exporter much sooner. Total exports to build 5 terminals, or total imports to build 5 terminals, would be 82 trillion cubic feet over the period to 2035. How much gas is in BC? There's various estimates of that. This is one estimate that is posted on the BC government, BC and LNG website, suggesting that BC has 2,933 trillion cubic feet of recoverable gas. The BC LNG Alliance has a posting on its website saying that BC has greater than 2,000 trillion cubic feet of recoverable gas. The BC Oil and Gas Commission and the National Energy Board published estimates back in 2013, and their estimates suggested that BC has 417 trillion cubic feet of remaining marketable resources. If we look at the difference in terminology, resources are much less certain than reserves. Reserves are proven by the drill bit, or are adjacent to areas that are proven by the drill bit, so they're much more certain. The 2012 estimates of the BC Oil and Gas Commission are 40 trillion cubic feet of proven raw gas reserves and 33.5 trillion cubic feet of proven marketable reserves. So there's an incredible difference between the resources that we're actually certain about and what's in the LNG literature posted on the BC LNG website. So how much gas do we need for those various cases? The 5 terminal case we would need to produce somewhere between 4.3 and 4.9 times the proven raw gas reserves by 2040. If we don't build any terminals, so I have a no terminal case, just to keep BC gas production flat, we're still going to need to produce all of those raw gas reserves. Certainly more drilling will move more resources into the reserve category, so that 40 TCF is not going to stay constant. It will grow over time. But will it grow to be 5 times the current level by 2040 and have it produced and sold to Asia? I don't know. I think that's an aggressive forecast. In order to calculate how many wells you need to drill in order to produce that much gas, we can look at the decline curve analysis, the same as we did with the Barnett play in Texas. And we can see, for example, that Horn River wells are much more productive than the average BC well, the black dotted line, or than Montney wells. They have steep decline rates, however. The average BC horizontal well drilled in the Horn River declined 71% in the first 3 years. The average Montney horizontal well declined 62% in the first 3 years. So as we saw in the US, you've got to keep drilling. This is what BC oil and gas, the distribution of BC oil and gas wells to date. The red wells are gas wells, the black wells are oil wells. There's about 25,000 wells that have been drilled since 1954 in BC. How many wells would we have to drill in order to meet each of those 5 terminal cases? Well, if you believe the NEB forecast again, that the BC gas production is going to triple, in the 5 terminal case, we need to drill close to 44,000 wells. So you can add those to the 25,000 that we've already drilled. So it will be close to 70,000 wells by 2040 in order to deliver that gas. If we don't build any terminals, but BC gas production grows to meet Canadian requirements, we still need to drill nearly 14,000 wells. So gas development is not going to stop in BC in any of these scenarios. If we look at the second case where we just maintain BC gas production at current levels, we don't need to drill quite as many wells. 37,800 wells in the 5 terminal case. And just to keep BC gas production flat to 2040, we're still going to need to drill nearly 8,000 wells. Environmental impacts, I assessed those briefly, but they include the land disturbance for the terminals themselves and for the major pipelines needed to supply the terminals. Land disturbance associated with the wells themselves, well pads, gathering pipelines, roads, seismic activities, water consumption. An average Horn River well uses 25 million gallons of water, US gallons of water, and an average Montney well uses 3.5 million gallons. This compares to an average of about 5 million gallons for the average US shale well. Truck traffic to deliver 25 million gallons of water to a Horn River well, we need more than 2,500 truck trips. For a Montney well, about 400 truck trips. Then there's the question of greenhouse gas emissions. All of those activities have emissions associated with them. I was able to get some information from the BC Oil and Gas Commission about their assumptions in terms of surface land disturbance for the drilling itself. So I assume multi-well pads will drill 10 wells per pad. Each well pad will be 4 hectares in area and will be serviced by 3 kilometers of roads and 3.5 kilometers of pipelines. There will be no additional disturbance from seismic cut lines. The BC Oil and Gas Commission thought that there's enough cut lines up there already that perhaps they wouldn't need to build any new ones. However, historically, 60% of the surface disturbance has been seismic cut lines. The disturbance claims, this is another page from the BC LNG website, claims 50 square kilometers by 2025. In fact, if we build these terminals, they will last at least 20 years. You don't make a $10 billion investment without having at least a 20-year life, and likely a 25-year life. So my calculations range from somewhere between 616 to 744 square kilometers of surface disturbance. If we look at where the wells will be drilled, they'll be drilled in the prospective parts of the Montney and Horn River plays. They won't be drilled everywhere in northeastern BC. So the land disturbance will be concentrated in the prospective parts of the northeast. Prospective parts of the Montney and Horn River are about 17,000 square kilometers as opposed to 1.7 million square kilometers for the northeast as a whole. So if you focus that surface disturbance within that prospective area, this is what it looks like. The 5-terminal case, you disturb around 4% of the total landscape. In the no-terminal case, you still disturb about 1% of the total landscape. So as I said, natural gas development is not going away, but it will be radically scaled back if we don't build 5 LNG terminals. Water consumption. Again, this is a page off the government website suggesting at maximum consumption rates it will only use 0.01% of all of the runoff in northeastern BC. But again, the water consumption will be focused on the areas of active drilling. So the actual impact on those areas, because water will be sourced locally as much as possible given all of those truck trips, will be higher. How fast you need to drill wells in order to service those, or in order to grow production enough for 5 LNG terminals. My calculation, during the ramp-up phase, we would have to increase drilling to about 2,100 wells per year. After we hit that plateau, drilling can be scaled back a little bit, but generally between 1,500 and 2,000 wells per year would have to be drilled for the period between 2021 and 2040. What is that? If we know the average consumption per well, we can calculate the volume of water that we need, the rate of consumption of water. And I compared that to the city of Calgary or the city of Vancouver. And at peak water consumption rates, we're about half of the consumption of a city of 1 million people. And people say, well, is that a lot? Is that a little? If you look at Northeast BC compared to Texas, it is relatively wet. So I'm not saying it's impossible to get to those consumption rates, but they are high. A final issue is the first point in that BC Throne speech will cut global emissions, will displace coal and China with clean burning BC LNG. And it's true, if you compare burner tip emissions of gas to coal, coal has double the footprint, double the greenhouse gas emissions of gas. But the problem with gas is that it produces a lot of fugitive methane along the way. Methane associated with the fracking process. The US EPA would say that's about 3% of the total lifetime production of those wells. Leakage in the processing and the pipeline, movement of the gas to the coast, leakage in the liquefaction, and basically the emissions from burning gas to liquefy the LNG, tanker transport, regasification. So you really have to look at the life cycle emissions from the wellhead to the burner tip in order to get an idea of the overall comparison. Methane on a 20-year time frame is about 70 times as potent as CO2 as a greenhouse gas. Methane has a much shorter residence time in the atmosphere than CO2. So on a 100-year basis, methane is only 25 times as potent as CO2 from a greenhouse gas perspective. So if you do the comparison on a 20-year time frame, if you built best technology coal plants in China, so these are not old coal at 33% efficiency, these are ultra supercritical coal plants at 46% efficiency. So if you compare best technology coal to BC LNG, emissions would be 27% worse for BC LNG over a 20-year time frame. Over a 100-year time frame, they'd be 7% better. But the point is, you're going to have to wait for 50 years before there's any improvement. It's going to make things worse up until that point in time. And some people would suggest we don't have 50 years to wait in terms of the global warming problem. If we look at emissions compared to, Canada was a signatory on the Copenhagen Accord. That committed us to reduce emissions by something like 17% over 2005 levels by 2020. And so that decrease in emissions is that solid blue line out to 2020. So that's what Canada committed to. And I've just projected declines at that rate just to see what that might look like out to 2035. Right now, this is the latest emissions data out of Environment Canada. Right now, upstream emissions from oil and gas are about 25% of Canada's total emissions. So 75% is everything else. If we grow oil sands by the reference case, this is a projection out of the Canadian Energy Research Institute, emissions from oil sands will go up a lot. This is the NEB reference case emissions from natural gas. So projecting that out to 2035, by 2035, Canada's emissions from the upstream oil and gas sector would be 57% of the country's total if we actually met the Copenhagen decrease rates. So all of the rest of the non-upstream oil and gas emissions in Canada would have to decrease by 59% by 2035 in order to meet the Copenhagen Accord. That's going to be very difficult. If we actually built 5 LNG terminals, this is what it would look like. So it's even worse. In that case, 2/3 of emissions by 2035 would be associated with the upstream oil and gas sector, and only 1/3 of emissions with everything else that Canadians do. So all the non-upstream oil and gas emissions would have to contract by 68% by 2035. So again, an extremely difficult projection. Financial risks and considerations. The whole reason for the excitement around LNG was the differential between the price of LNG in China and Japan. 2 or 3 years ago, Japan was at about $18 a unit for LNG. It's now under $8. So the arbitrage has disappeared. And that was really the attraction of building these LNG plants. Conservatively, upstream investment is like $10 billion for a plant. So companies need assurance of they're going to get payback over the long term in order to commit that capital up front. And that's by no means assured. And if you look at what I said about the nature of shale in North America, it looks like the price is going to go back up. If the price of gas went to, say, $5 or $6, and it cost you $6 to move it to Asia, then you need $12 in Asia in order to break even. So if prices go up in North America, then the risk intensifies for LNG. We've seen a halving of the LNG tax, and we've seen an increase in the rate of write-offs for the plants. So that the tax take of government to really contribute to the owners of the resource, which are the people of BC, is becoming pretty thin on the ground. When do we get payback? Well, we get payback after those plants have been paid for and the corporations have really got their investment back. Corporations understand these risks very well. Hence, it's not surprising to me that there have been no commitments to go ahead, even given all the tax breaks and government support. Just a quick snapshot of current LNG prices in the world. You can see in China, $7.45, Japan, $7.85. So these are down $10 from where they were 3 years ago. There's no way that anybody in their right mind would build an LNG plant if they thought that those prices were going to remain for a fairly long period of time. I don't think they will. I think they'll go back up, but it's just a question of timing. So just to summarize, it's clear to me that oil and gas are likely to remain an important component of energy consumption for decades, given their energy density and utility, for which there are few substitutes. So we'll need those resources. The shale revolution has been a game changer, but its sustainability in the long term is questionable. This implies higher domestic prices in the future, reducing or eliminating arbitrage for LNG exports. NEB forecasts are optimistic, yet indicate that even if BC production more than triples, one LNG terminal would use up all of Canadian export capacity. Developing 3 to 5 terminals would make Canada a major net importer of gas, unless production could be ramped up far higher than NEB projections. The BC government statements of 2,933 trillion cubic feet of recoverable gas resources are contradicted by its own BC Oil and Gas Commission and the NEB. They are overstated by a factor of 7. The BC government statements on land disturbance and water consumption downplay impacts as they spread them over the whole of the entire northeast of BC and look only out to 2025. In fact, the lifespan of an LNG terminal is at least 20 years, and the upstream impacts would be concentrated in a small portion of the northeast where the actual drilling is occurring. The BC government's claim that LNG will reduce global greenhouse gas emissions considers only emissions at the burner tip, not full cycle emissions, including production, liquefaction, and transport. In fact, the world would be better off if China built best technology coal plants rather than burning BC LNG over at least the next 50 years. The Copenhagen Accord, to which Canada is a signatory, is a modest effort to control greenhouse gas emissions and is insufficient, according to many. Exporting BC LNG at the scale envisaged would make meeting even this target much more difficult, as well as compromise Canada's long-term energy security. So just a couple of parting thoughts. Canada's de facto energy strategy is expediting the liquidation of its finite, non-renewable resources as quickly as possible in the name of economic development and the government of the day. These strategic resources are one-time and likely will be needed domestically in the future. They come with collateral environmental impacts and deserve a longer-term plan for the sake of future generations and the environment. So, thank you very much. I'd just like to leave you with the title of the report that will be coming out in the middle of next month sometime. Thanks.